How to track inflation numbers. When the Fed mentioned their 2% inflation target, are they referring to the commonly published CPI that we often read about? Or are they referring to the Core CPI? Or maybe could it be the Core PCE? And why are these numbers important? When inflation rises, the central bank may choose to hold off on cutting interest rate. Or worse, they may raise them. And this leads to a higher borrowing cost, which can impact the stock market. Let's explore which inflation data the Fed is closely monitoring and the inflation direction as well. I'm Kon Hao. My work in this channel is to study behavioral science and finance, discover correlation between different markets, and uncover potential opportunities. And the Fed preferred tool in measuring inflation is the Core PCE. Before we understand the reason why this data is their preferred tool, let's first understand what is CPI and Core CPI. CPI, or known as the Consumer Price Index, include all items such as food and energy, and is often the headline numbers that we all read reported in the media. Whereas for the Core CPI, it excludes food and energy to provide a less volatile measure of underlying inflation. And let's take a look at the characteristic between these two data. First, the CPI, which include overall data. And we can see that I leave this benchmark, 2% benchmark that the Fed target all this while. And over the past years, you could see that the inflation is indeed very volatile. And Fed do use that, but it will take it as a reference. But to minus off the food and energy, you could see immediately that the inflation data is not as volatile as those that include food and energy. And their preferred tool is the Core Personal Consumption Expenditure. It is considered as a broader spending patterns, and it excludes volatile food and energy prices similar to the Core CPI. It accounts for the substitute effect, meaning it is more accurate for the Fed to monitor when consumers shift their purchasing habits in response to price changes. And this provides a broader view of inflation by including adjustment for changes in consumer behavior. The Fed believes this measure better reflects overall economic trends and is less affected by temporary price shock. For example, a sudden jump in egg or energy prices. And let's take a look at their characteristic. And we can see that the Core PCE in the 60s, before the high inflation in the 70s and 80s, it was almost on track between 2 to 1%. And even in the 90s, the roaring 21st century, the inflation data mostly stayed this band between 1 or 2%, almost there. And today is at 2.6, is still a little bit far off from the 2% target. So what the Fed wanted to see is that it continued to drop to 2% and stay there. And that's what they want to see. And for Core PCE compared to the rest, you can see that it is much more stable. And in the latest FOMC meeting regarding the tariffs' impact to inflation, Jerome Powell said it is going to be very difficult to have a precise assessment on how much of inflation is coming from tariff. Trying to track back to actual tariff increases is very, very challenging. And that's what he said. To assess the direction of inflation because of tariff, and I believe they are going to make a decision meeting by meeting based on the incoming data, the evolving outlook, and the balance of risk. It is not just current, but in the future, what the data is going to be. He has no clear answer to it, and Jerome Powell did not commit anything, whether he's going to cut rate or hike rate. But he just said a very responsible statement that he's going to continue to monitor the incoming data. In behavior analysis, I would always like to compare related market and see what are these investors telling us about inflation. And let's study into the different tenure of the lending rates. And what we can see here is the 2, 5, 10, and 30 years yield or borrowing rates or lending rates, whatever you call that. But my reading is this. When inflation is higher, interest rate or yield also moving higher. Or it could be the other way, that this market are driven by investors and traders. When they drive up all this yield, it also means that the sentiment created by them, that they're seeing that inflation could be higher. Now let's study into this market, the cash market of the yields. What I'm seeing here is that we could see that over the last 40 years, since 2022, not just the 2 years, but 5 and 10 and 30 years, it gives me a very consistent reading here, is that it has broke above this 40 years of downtrend, low interest rate. And I'm expecting that in based on just this structure alone, that there's a tendency that the interest rate or the yield or the borrowing rates or the lending rates could be on the rise. From the yield markets, it is indicating to us that there's still a risk of higher inflation. Though each inflation numbers that we studied earlier, the Core PCE, the CPI, and the Core CPI have their characteristic, but their overall trend, it move in tandem, which it seems like it's still moving higher. We cannot perfectly time the market, but it is possible to get the market timing right. The market are always telling us on their next move. Stay tuned for my coming tutorial. Remember to subscribe to my channel. Join us in our weekly case study and discussion. Click on my profile icon or description below to find out more. Feel free to leave any comments below. I love to exchange ideas with you on what is about to come. Really happy that you stay through this tutorial. You have many great trading weeks ahead.